Hi there, welcome to Kneppy Invest and another technical update video. An absolutely gorgeous day in Brisbane on April the 14th, 2024. Autumn or fall, depending on your persuasion, is already half over. Can't believe it, but time does go quicker as you go older. So, of course, in a technical update video, go through the indices first. We'll have a look at commodities, bonds, Bitcoin, and then I'll bring you 10 companies on the ASX that are looking interesting for various reasons. And all 10 companies I don't own. Well, to be honest with you, there's 9 companies and 1 TF. I very rarely show you ETFs. If I was to give any sort of advice to someone who's just starting investing, I would say ETFs. Just go ETFs. Don't invest in individual companies until you become comfortable knowing what to look for and what sort of companies you want to invest. ETFs is the way to go. Is what I would say if I was a financial advisor to someone who is just starting investing, but I am not a financial advisor. So keep that in mind. That is not advice. That's what I would do if I knew nothing. But if I knew nothing, I probably wouldn't know I should do that. Anyway, let's start off with the indices today, and this is the weekly chart for the XJO, which is the ASX 200. Nothing looks bad about this chart. In fact, the past week, the XJO was up 0.2%, a little bit of volatility during the week. Now, interesting enough, I was just having a look at this, and we're still in a long-term uptrend. That's without doubt, because this longer-term moving average channel, which is this lower shaded area with the blue line running through it. So it's on about the 150, 200-week moving average, and the blue line is the 150-week moving average. That's green. Tells me we're in a long-term uptrend. And in fact, it's been green ever since 2012, 13. And that's just coming off the GFC, and there was a fair bit of volatility as we came out of the GFC. When I started investing back in 2010 or so, somewhere around there, I think it was 2011, I was continually told it's just too risky. The stock market is way too risky, and that was the time to invest. In fact, the time to invest was 2009. So I missed it by about 1 or 2 years. But yeah, that was a great time to invest. And XJO has been in this upwards trading channel for about 15 years. Now, what is interesting about this, I just really noticed this, is whenever the XJO just goes below that longer term moving average channel, that's the time to probably go 100% all in. It falls below it on occasion. The most recent time was during June, I believe it's June 2022. I could be an absolute lie. No, it wasn't June 2022. It was October last year. And it also fell below it in June. In fact, there was a double bottom here, June 2022 and September 2022. And those are the time to become really interested in maybe going 100% into the stock market, particularly if the XJO is getting towards the bottom of the trading range. We have seen it a few times during the COVID-19 financial panic. It fell through and then bounced back fairly quickly, the V-shaped recovery. It also hit the bottom of the trading range back in 2018. And if you remember 2018, or maybe you don't because you're new to investing, in the last few months of 2018, there was a lot of concerns about the potential of rising interest rates, and that's why we saw a lot of weakness in indices around the world. And that's where we saw the XJO hit the bottom of the trading range. We also saw it hit the bottom of the trading range in 2016, which is understandable if you know how our market operates. We are highly dependent on not only banks, but also mining companies, BHP, Rio Tinto, Fortescue. And that was at the bottom of the iron ore cycle. In fact, let's have a look at the iron ore price right now and have a look at the weekly chart for iron ore. If we go back to 2016, there it is. It reached a bottom of about, in fact, fell below $40 back in late 2015, early 2016. And that coincides where the XJO had a little bit of weakness. So we are still highly reliant on iron ore and stuff like that. But back to the XJO, it still looks pretty bullish. So there's no reason to panic right now. Now, you could say it's more towards the top of the trading range than the bottom, and maybe that's why we should be a little bit wary and careful. Maybe not go completely in if we have new money. And last time we saw us get towards the top of the trading range back in towards the end of 2021, we did see a little bit of weakness, and that's moving into June 2022. And also, that's when we started to see increasing inflation, increasing interest rates, that sort of thing. But overall, weekly chart for the SJO looks good, and last week was actually good. Now, I do expect a little bit of weakness on Monday because the Nasdaq was down, Dow Jones was down, and S&P 500 down. So I do expect a down day on the XJO. I would probably expect at this point in time maybe down 1% and maybe 0.5% either side of that. So I wouldn't be surprised to see us only down 0.5% or down 1.5%. Now let's have a look at the XSO, which is the small caps. How's that looking? So not quite as bullish as the XGO. In fact, if you do look at that longer term moving average channel, it actually went red not that long ago. It was actually red towards the end of 2023 because we had fair bit of weakness in the small caps, which is understandable. We know that. And if you do actually have a look at the longer term chart for the small ords, the long-term moving average channel was red between 2011 and all the way through to 2016. And then we saw a bit of love coming in for small caps midway through 2016. So then we had good times for small caps between 2016 and 2021. So a little bit less of a trend when it comes to small caps on the ASX. But if we hone in on what's happening now, another good week for the small caps, up 0.5%. So it did beat the XGO and is hovering around a fairly important, really important breakout level. So that's around about or just below 3,100. You see it's struggling to get above that. This is the daily chart now. It's been struggling ever since the 21st of March, going above it, then falling below, going above, falling below. So a very important level for the XSO. And again, I do expect this index to fall. But last time it fell, which was on the 11th of April. Remember, that was we opened up down really big on that day, and then we recovered during the day. And on that particular day, the small caps opened at 3,097. The low of the day was 3,049, and then finished the day. No, opened 3,097. Low, closed 3,077. Okay, yeah, that makes sense. Okay. The open was the close of the previous day. But the low was 3,000 and what was it? 3,049.3 and closed at 3,077.6. So it fell from 3,097 to 3,049 and then recovered to 3,077 during the day. Okay, so let's have a look at some overseas indices, starting with, of course, the American indices and the NDQ or the Nasdaq. So there's an NDQ indice and also an NDQ ETF. So just want to make that clear. And in TradingView, if you just put the NDQ in, there it is. So we have the US 100 index, and there just below that, the Beta Shares ETF. So two different, they're sort of tracking the same thing. I'm pretty sure the NDQ ETF is the 100, Nasdaq 100. I'm pretty sure about that. So they should be fairly similar. Anyway, let's have a look at the NDQ. This is the Nasdaq 100. And we'll start, of course, with the weekly chart because this is a weekly video series. So should be looking at the weekly. Anyway, so 2 down weeks in a row. Nasdaq down 0.8% last week, down 0.6% this week. Is that any reason to be nervous? Second time we have seen 2 down weeks in a row in the past 6 weeks. So we've been down, down, up, and down, down. No reason to be nervous right now. But if you go through the last few months, Nasdaq did go on a bit of a tear. In fact, it was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 out of 15 weeks up in a row from October. And before that, we did have a period where we saw 3 weeks down, 3 weeks down, and 2 weeks down. So wouldn't be surprised to see another week down. If we get to like 4 or 5 weeks down in a row, that means we're probably in a short-term correction, like we had back in 2022. But overall, if you look at the weekly chart for the Nasdaq, it's still in an uptrend. So no reason to be concerned. There's no reason to say we're still not in the bull market when it comes to the Nasdaq. It's showing a touch of I'd say a touch of weakness. Um, it has leveled off a little bit if you look at the daily chart. If we get, or Nasdaq gets above 18,400, that would be good because that would be an all-time high. So not far off that right now, but just looking at the short term, they're very short term. Nothing overly exciting right now, but no reason to become distressed or sell everything. Might get a little bit of this different perspective when we look at the other few, the Russell 2000 and the Dow Jones. Let's have a look at the Dow Jones first. So two actually big down weeks in a row. So 1 week down, or last week down 2.27%, and this week down 2.37%. So after a nice period from October where the Dow Jones was or roared higher, two negative weeks in a row. And the last time the Dow Jones had, well, the last time the Dow Jones had two big down weeks in a row, would I say October 1.6? Yeah, October. So the weakness it's looked since October of last year. So nothing to be too concerned with at this point in time. And because it went on a really good tear, we should expect a little bit of weakness, a fair bit of profit taking, still a little bit of debate out there. What's going to be happening with the economies around the world? Are we going to be moving into recession? That sort of thing. A little bit of concern around the world about what's happening between Iran, Israel, United States. Of course, I'm recording this video just after Iran sent quite a few drones and missiles towards Israel, and the majority of those were picked up by Israel's defense system, understandably so. But a few got through. I think at least one got through. That did cause a girl to be injured, if I remember correctly. So there are concerns about that. But you think if there are concerns about that, oil should be on a bit of a tear. We'll have a look at oil in a second. Maybe not a second, a few minutes. Well, quite a few minutes from now anyway. So Dow Jones does look a little bit weaker than it was, but that's understandable, bit of profit taking. Now onto the Russell 2000. This has been fairly weak the last 2 weeks, just like the Dow Jones, down 2.9%, and actually 2.9% 2 weeks in a row. And this is after it looked like it had just broken out, and now it's fallen below that breakout level. So that could have been a false breakout, although it broke out and remained above that level for about 6 weeks. And of course, this index, which is the smallest 2,000 companies in the Russell 3000. Russell 3000 consists of companies on the New York Stock Exchange and the Nasdaq. So this is like a small cap proxy. In fact, it's called the US Small Cap 2000 Index, which is the Russell 2000. That's how I refer to it. And this doesn't look as bullish, nowhere near as bullish as the Nasdaq and Dow Jones over the long term. So again, this is the weekly chart. So fairly similar to the XSO, and just shows you there has been a fair bit of weakness in the small caps over the past few years. If we go back in time, unlike the XSO, which was weak between, was it 2011, 2016? That was not the case for the Russell 2000. And if you actually have a look at the long-term moving average channel for the Russell 2000, it's been an uptrend since 2009. So still a long-term uptrend for the Russell 2000. And in fact, I didn't have a look at the Dow Jones long-term moving average channel, and this has been, again, uptrend since 2009. So again, long-term uptrend. And the time to get interested in the American markets is whenever the Dow Jones falls below the long-term moving average channel, which doesn't happen all that often. Most recently, October 2022. To have a look at the Nasdaq long-term moving average channel, that's pretty obvious. Whenever it falls towards the long-term channel, it's a buying opportunity. We saw it March or during the COVID-19 financial panic, late 2018. We saw it again in 2015 for a brief period of time. Well, maybe not a brief, but a fairly long period of time during 2022. And during this period is when I bought quite a few companies on the Nasdaq and New York Stock Exchange because of just what was happening in the markets. I thought this is the time to start buying these companies, and that was good timing. Sometimes you can time the market. You can't perfectly time the market, but sometimes you can do a good job of timing the market. And that was an instance when I started buying these tech companies at a point in where there was a bit of weakness in the markets. Okay. Nikkei 2000 weekly. Yeah, it's staying above the all-time high, or staying above the breakout, which was the highs we saw back in late 1989. It's just lingering above it. That's a good sign. So we haven't seen it fall below 39,000. So the Nikkei still looks pretty strong right now after a really good time in the past year. Yeah, it's almost a year ago where we saw it really take off, 28,000 to 39,000. I think that's all I got for the indices. We could have a look at, in fact, I'll go to my markets and see, there's the DAX. Let's have a look at the DAX. The DAX looks pretty good. Two down weeks in a row for the DAX, just like the Dow Jones. I wonder if there's a bit of a link between the two. Maybe there is. And the UK, so the FTSE 100. Yeah, it's in a resistance zone. That's why I've got two lines here. 7,800, 8,000. That's a resistance zone, and it's right in that resistance zone right now. The FTSE, and that's what I've got for indices right now. Let's have a look at, if I can find it, video technical. Let's have a look at the commodities, and of course we start with gold. And gold is down in the last day, which is Friday. I'm recording this day on Sunday, so it's 2 days ago, to be fair. So this is the weekly chart for gold, and yes, it broke out quite a few weeks ago, and hopefully you know about that. And a beautiful breakout it was, because that level at around about 2080 was a fairly significant level for gold, and I think I've mentioned this time and time again, every single time since middle to late 2020. Every single time gold got to 2080, it struggled to break free. Did about 3 or 4 times and just struggled. And then all of a sudden, it just broke through on really good strength. So gold broke out a few weeks ago. In fact, I'd say it broke out the week of 4th of March, 2024. So actually over a month ago. And it's still going up. Now, this 1 week candlestick looks pretty, well, I wouldn't say ugly, but it does look a little bit more bearish. So a bit of selling coming in. You can see the last 2 weeks, the candlesticks there, a green body with no shadow, which means the low of the week was at the start of the week, the high of the week was at the end of the week. This week, a little bit of difference. We do see a bit of a shadow above the main body, or an apple tail, whatever you want to call it, which means there's a little bit of selling coming in during the week. So let's have a look at the daily chart for gold. And that weakness was in the last day, on Friday. So even though gold is on a tear, you can see on occasion gold has a weak day, a nice little consolidation period back in the middle of March, just after it broke out. That's beautiful. Beautiful trade, beautiful technicals right there. Exactly what you want to see. So I'm not sure what to think about gold on Friday. Why did it rally? Not rally. What's the opposite of rally? Why did it drop? I think I did have a look at this. Yeah, it just dropped precipitously on really big volume. So we had some really high volume near the tops of the day, and that volume continued as it started to fall. And you can just see the volume just dropping through the day. And then it hit a bottom at about 2,336, and it's gone sideways since then. But the last time gold was traded was early morning, April 13th, our time, which is understandable because the rest of the world is still, well, a lot of the rest of the world is still on Friday or in Friday at that point in time. So gold looks, well, weekly looks beautiful. 1 week candlestick looks a little bit dodgy, but that doesn't mean anything. We've seen that before. Although, compare that candlestick to this candlestick back in 7th of March 2022. And that particular week, gold did hit 2070, so just shy of 2080, and pulled all the way back to 1,988 by the end of the week. That's the sort of candlestick, 1 week candlestick we are looking at right now. So whenever you see a little bit of a shadow above the main body, that's telling us there's a bit of weakness and there's a bit of selling coming in. And you can see that last time we saw that was actually on December, when actually remember that week where the gold broke out, and everyone will say, oh, gold's broken out. They're still saying that a week after it broke out and then failed. Have a look at the daily chart for that. And that has the same, there it is, on the 4th of March. Or 4th of December, not March, 4th of December, it broke out and then fell away during the next 6 or 7 trading days. It went from 2,150 all the way back down to 1,975. Okay, so And in fact, that one-day candlestick is fairly similar to this one. So this is the first sign of maybe a little bit of weakness in gold, just this one-day candlestick. But there might be some reasons behind that. Onto iron ore. So nice little rally over the past 7 or 8 days, $98 to $108. That's pretty good. But is this just a dead cat bounce? It's moved into the short-term moving average channel. So if we see that it pulling back, that would confirm that this was just a little bit of a correction, an anti-movement, whatever you want to call it, into a downtrend. So in an uptrend, you see a little bit of a pullback and then moving up higher. So by the dip situation, this could be the reverse of that, or a dead cat bounce. So no, not bullish about iron ore just yet. I need confirmation that the bottom has been reached. And that bottom would be $98. Okay, uranium still below 90. Let's have a look at the line chart. I think the bottom has been reached. I think I'm calling it right now. And it reached when it hit the longer-term moving average channel. In fact, the 150-week moving or daily channel, not the week. This is the daily chart. The 150-day moving average. 150-day moving average, exponential moving average, by the way. And if you do actually look at the short-term moving average channel, it has gone red. So a short-term uptrend. What some people might do is they'll try to draw a trend line here like this. And they might say, oh, it's broken. It's broken the downtrend. I'm not quite there. It only touched it twice. I would prefer at least downtrend or uptrend touch the line at least 3 times. And uranium has not done that. But I think the bottom possible, the short-term bottom has been reached because of a nice little bounce of the 150-day moving average channel. Let's go back to candlesticks and let's have a look at oil. So we probably, if there was a bit of concern about the Middle East, you'd probably think that oil would have been on a bit of a tear. That's not true. In fact, oil in the past week is flat. Let's have a look at the weekly chart. Flat is, well, down 1.5%. I suppose is not flat, but that's after a nice rally the previous 2 weeks, up 3% and then 4%. So if we look at the daily chart, it still looks pretty good. This could be a little consolidation period where oil just goes sideways for a week or maybe 2 weeks, and then it goes back into a nice uptrend. But definitely well above its lows. Lows were about 68, now it's 86, and it's moving towards the top. The recent tops we saw back in September last year when oil got to $94. If we look at the weekly chart, still, I'd say, yeah, nothing too exciting look in the weekly chart. Nothing like back in 2021, 2022, when oil was an absolute tear, going all the way up to $130 at its peak. Lithium. Lithium futures had a nice little day here. This is the weekly chart. It looks okay, but fair bit of volatility the last, say, 2 or so months. But I think the downtrend has come to an end. Now might be a time to think about buying or thinking about what lithium companies you might buy if we start to see lithium rise again. So 3 good up weeks out of the last 6, but we've also had down weeks. So over the last 6 to 8 weeks, the lithium prices are flat, according to this particular chart. Copper. Start with the weekly chart. Copper had a good week, another good week, up 0.5% after up 5.7%. So it's good we didn't see weakness and volume. Highest volume we've seen in copper for quite a while, since 2021. And daily chart, I did notice there has been a fair bit of volatility the last 5 days. But this chart looks pretty good. Still looks pretty good. You haven't seen a pullback back to the short-term moving average channel like we saw back in March. So it broke out, pulled back, it tested the short-term moving average channel, also tested the breakout level, and then pushed higher. So a little bit of volatility because you can see on Friday, copper prices, open at 426, high 436, low 424, and close at 426. So a fair bit of volatility there in copper, but still looks pretty good. Pretty good. And a few copper companies on the ASX are doing really well. Ares Resources went up 20-25% on Friday. That chart looks pretty good. Coal, I don't think much is happening with coal. Still going sideways. Has been a nice little rally in Whitehaven, maybe a few other coal companies. This is Newcastle Coal, by the way, futures. And let's go to my markets. Is there anything else? Maybe silver. Silver. Oh yeah, silver. I mean, it should be fairly not completely correlated to gold, but there should be a bit of correlation there. And silver had an interesting last day of trading, but it did break out on the 3rd of April. Look at the weekly chart for silver. It looks pretty good. Last time silver was this high was way back in 2020 and 2021. Now, if you go back to then, you can see there was a lot of weakness there. And I would like to see silver probably get above, at the end of the week, get above about, we'll say $29. If I see silver close above $29, that would be a really good move. That would be a significant breakout for silver. It has been higher. Was higher way back in 2012-13. There we go. Anyway, so looking good for silver. There's a few plays with silver. Adriatic Metals. Someone mentioned Silver Mines, SVL. There's probably a few other silver companies on the ASX, but there's not many, to be honest with you. So I do know two now. Adriatic and Silver Mines something, SVL. Anything else here? I'm pretty sure I have like nickel, but I have to show you the line. Oh, no, that's Nikkei, not Nikkei. That's Nikkei, not nickel. Where's nickel? That's tin. I'm pretty sure I had nickel. There it is, nickel. Sorry, nickel. And I have to show you the line chart for this. And yeah, this looks pretty good. So we have had a new higher high. So a high low, a higher high. This is starting to look interesting, nickel. You are starting to look interesting, nickel. Nickel, what's nickel on the ASX? There's a few nickel companies. And then tin, this one's Metals X. And Metals X had a massive week up. And I missed this one, but this has, broken out. I would say the breakout was this right there. That was a breakout which happened late last week, and then it's continued to climb. So nickel looks tin looks really good. Palladium, haven't had a look at this for a while. That's starting to turn too. And what's CJ1? That would be cocoa. Cocoa is still rising. Oh, what's going to happen to our chocolate? Oh, that's terrible. The humanity. I'm joking a little bit, but I do like chocolate, so hopefully that's not going to affect the chocolate industry too much. Let's have a look at Bitcoin and the bonds. We'll start off with Bitcoin. So Bitcoin trades every single day. Ooh, look at that. A little bit of weakness. So down on Saturday by 4.6% after falling 4.1% on Friday. Flat today, Sunday. I'm not sure how long it's traded. In fact, we might be able to tell, say, look at the 5-minute chart maybe. When did the day start? It wasn't here. So it started somewhere, I'd say maybe 10 a.m., which would make sense. That's about 0Z at GMT. So about 10 a.m. local time, yeah. Okay. So it's based off GMT. Okay. I thought it might have been based in America, but anyway. That's just me being Americanized. Anyway, so I'm going to put a line, Bitcoin, right there. So why did I put it there? So we sort of had a really nice rally to that level, and then it went sideways for a few days, and then started on its tear again, and then it pulled back to this level, which is around about 62,000. Pulled back to 62,000 in the middle of March and then went higher, but it didn't get to a new high. That's the concerning thing. I got to about 72,000 and pulled back. And then it pulled back again yesterday on the Saturday, and now we've seen it recover a little bit. So if 62,000 is broken for Bitcoin, that would be a little bit concerning, and that could be a sign of a little bit of bearishness in Bitcoin. Ethereum, what about Ethereum? Oh, I think Ethereum's broken out to the downside. I'd probably put again around about there, and that's looks a little bit weaker, but it's moving to the longer term moving average channel, and we did see a rally off that. So that could be the support level for Ethereum. Now onto bonds. Just going to go back to my video technical watch lists. Bonds. So bonds have been rattling because inflation a little bit more stickier than thought, which is why we're seeing a little bit of weakness in tech companies and Dow Jones, small caps. Although last week, or no, the last day, bonds are down. That's good. So bonds are up on Wednesday by 2.8%, and then another 1.2% on Thursday. And if this was an individual company, this was a breakout. We've seen bonds or the 30 years bonds break out. So what I'd probably do here with bonds is there is an uptrend developing. It looks like a fairly well-defined uptrend. Just by putting a line like that, you can see definitely the bonds, we're seeing higher highs and now a higher lows, and now a higher high. And yeah, 4.6. It was down as low as below 4% back in December. So the bond markets have got this completely wrong. So remember back then, the bond market said there was going to be 5,000 interest rate cuts in 2024, and now there might be zero. So the bonds got that completely wrong. They got inflation wrong. We always seem to get inflation wrong. We have no idea about inflation. They think raising interest rates is going to fix inflation. Yeah, I don't know about that. I'd like to see way more research and if that's the right solution. They were crowing saying, oh, look, say rising interest rates says dampen inflation. Really? Is that the reason? I'm not sure. And the reason why I say that is the whole reason they raised interest rates, it wasn't to necessarily decrease inflation. It was actually to increase the unemployment rate. And if you increase the unemployment rate with less people employed, that should put a dampener on spending. Now, the other thing is they raise interest rates, so mortgages go up, so people spend less as well. But one of the main reasons of increasing interest rates was to increase unemployment, because they don't want full unemployment, because they believe, this is their thinking, if we have full employment, that leads to wage pressures. So more likely to see significant wage rises, which makes sense because demand supply in employment, if there's not enough supply of people working, willing to work, wages will rise. There's going to be competition for employees, for people who want to work. So that's their thinking. So if you increase the unemployment rate, there'll be less pressure on wages, and that would have less pressure in inflation. They believe right now that the only thing that's leading to wage or inflation is wage rises. That's not true. I think someone said if we went back to the old way we calculate inflation, inflation would be over 10% now. So focusing on food, rent, that sort of thing. But we have governments around the world have manipulated the way we calculate inflation. So it seems like inflation is less than it actually is. That's why people are under stress. One of the main reasons people are under stress. Okay, rant over. So bonds are looking bullish, which means bond prices looking bearish. Bond yields bullish, bond prices bearish. We can see that by looking at the TLT ETF. This will be in a downtrend. Yep, look at that, looks bearish. So this is a bond ETF. So you think, why is that different? This is bond prices. That's bond yields. Bond yields and bond prices are inversely related. Okay, let's have a look at some individual companies on the ASX. So the 10 companies I'm going to feature in today's video include Orora, Telstra, Spark, I think that's Spark New Zealand, Michael Hill's Jewelers, Ansell, which I did mention in my daily rundown videos, GQG, you'll know that I have trouble with that particular ticker code. I always want to say QGQ, not GQG. Woolworths, Metcash, and ETF, the Asia ETF. Is that beta? And AGL. So actually some big companies in this list. I just realized that. So Telstra, Woolworths, AGL, I suppose Metcash, Ansell's pretty big. Aurora's big. In fact, they're all big. I think Michael Jewelers might be the smallest one, and that has a market cap of maybe $300 million. Okay, so let's start with Orora. There's a few reasons why I've included these companies in this particular video. So one of the things I look for is long-term support levels. And Orora is moving towards that, which is $2.10. Orora right now, $2.17. So look at the long-term support levels. We need to look at least the weekly chart. And Orora fell to $2.10 back in 2020. So August, September 2020. Maybe even longer, maybe? No, No. So that's why that's a long-term support level. So investors would know, maybe subconsciously, I don't know. So some investors would know that Orora got down to about $2.10 back in 2020. So right there, that's a support level because based off their um, knowledge of Aurora's history or whatever, or reasons, not recency bias, but just they would think, oh, I missed buying Orora at $2.10 in August, September 2020. Now I have my opportunity to buy this company. I wouldn't say this company is a high quality company. Now, if you don't know what this company does, just go to some packaging in your wardrobe, in your cupboard, and look at some of the symbols. You might see Orora symbols on some of your packaging. So they're a packaging company. Markup is only 2.9 billion, which is interesting. If you look at the annual revenue of this company, yeah, it's increasing slowly. Low margins in this sort of company. Pack Group, which is a competitor, I would think, is being taken out. Other things about this company: dividend yield 6.45% and price earnings ratio 15.5. Although, let's have a look at the profit: $185 million of profit. But if you look at the semi-annual profit, was only $68 million in the last half year, and has fallen the last few half years. So I would say $150 million of profit, which would mean, yeah, this company's towards a 20 PE ratio. So you'd need the faith that the profit in this company would increase, but just because it's very close to the lows back in 2020 makes me not interested in this company. But I do have this on my buy Australia watch list because it is getting close to a really important level. And I would buy this as a bouncing off to $2.10. Now, in saying all that, it did release some negative trading update or something on the 2nd of April. Share price on that day fell 14.7% and has continued to fall since then. That is a bearish signal that the share price has continued to fall after the bad news. A very dissimilar than Elders. Elders bounced. And I sold out of Elders because sometimes I just don't know which way the share price is going to move. I'm just de-risking my position. Elders fell about 24% and then has bounced, which is a good sign. But Orora has not done that. It hasn't bounced. But maybe it'll bounce off $2.10. Okay, Telstra, one of the biggest companies on the ASX. Top 10, maybe? Actually, don't know. Market cap of only 43.4 billion. So maybe it's not top 10. Always can tell. If you don't know the size or where a company fits in the ASX, you could just go to somewhere on Market Index. They do have list of ASX companies. And then you can do it by market cap. And there it is. It's already done by market cap. So BHP, Commonwealth Bank of Australia, CSL, Telstra comes in at 13. So not top 10. Just shy of top 10. Yeah, that market cap of 43 billion. I thought it was a little bit higher than that. So coming in number 10 is Goodman Group. Yay, Goodman Group. So I own, let's have a look. So I own CSL and Goodman Group in my quality portfolio. Macquarie Group, meh. Wesfarmers, meh. I'm trading ANZ. And that's about it. WiseTech. I own WiseTech as well, coming in number 16. Aristocrat coming in 18. So even though, so I own in my quality portfolio 4 of the top 20 ASX companies. There you go. 5 of the top 21 because REA Group as well. Well, 26 is Xero. I own that. And 27 is ResMed. I own that. Oh, I can't believe I own quite a few of the biggest companies on the ASX. There you go. I should have a look at this more often. Anyway. So why Telstra? Well, have a look at the daily chart here. There should be obvious why Telstra straight away. Because Telstra, at a share price of $3.75, has seen support ever since the middle of 2022. It has hit $3.70 or 75 cents. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times in the past and has bounced off it. And Telstra share price right now is $3.76. Now, the most recent bounce wasn't that strong. So I wouldn't be surprised to see Telstra fall below 375, and this could be bad news moving forward for Telstra. This would be a sort of a bearish move for Telstra. Let's have a look at the weekly chart for this company. This is definitely not a long-term hold, by the way. I would never own this company for long-term. the time to buy this company is when it gets or looks pretty cheap. I would think about buying this company is if it fell below $3. That's what my aim would be. So still a little bit off that, but I'm just interested to see how this company performs over the next few days and whether it falls below 375 on strength. Says the PE ratio is 21.7. If that's a true PE ratio, this company is way too expensive, way too expensive. But I have a feeling that's not a true indication of the PE because the last half was weak. Not all that weak. So $2 billion of profit. Yeah, I don't know. It's a little annual. Yeah. If you look at the last 5 years, yeah, revenue down, profit down. That's why I would never say Telstra is a quality company. Everything's going down through time. Anyway, so that's the only reason I am looking at Telstra is just because of where their share price might fall from here. On to Spark New Zealand. Now, I would probably, you could argue that this is a quality company just based off this particular chart. This is the weekly chart. Share price of this company, Spark New Zealand, has been in uptrend since 2013, a long-term uptrend. And whenever the share price moves towards this long-term moving average channel with that blue line in the middle, we see it bounce off it. 1, sort of 2, 3, 4, 5, 6, 7, 8, 9. But what's happening now? It's fallen quite a bit below that moving average channel. Now, I'd put a line up here as a resistance area, and I put a line right there as a support area. And just based off this weekly chart, Spark New Zealand has fallen below that support level, and it's done it in the past week. So this is starting to look fairly bearish, but the plunge has been quite significant. So the company's share price reached the top of the trading range, or quite near its all-time high, back in February. So 2 months ago, company share price was $5. Now it's $4.30. I would not be surprised to see a bit of a bounce, at least a 10 to possibly even. So a 10% bounce would be $4.70, which was in the middle of the trading range. To get a 20% bounce, you'd need the share price to get above $5, which is the top of the trading range. So I wouldn't be surprised to see at least a 10% bounce when it comes to Spark New Zealand. But it has fallen below the support level. So that would be, or make me a little bit nervous. And we're not seeing massive volume coming in as well. So just because this company's fallen below support level, even though I do think there might be a bounce, someone asked me about RSI. I'm going to show you RSI now. Wouldn't be surprised to see RSI in like a negative, maybe not negative. So in this below the bottom, which would tell me it's oversold. When it's oversold, that's when you might see a bounce. It's not perfect RSI. A lot of times I see it in the overbought or oversold section, and then you don't see the bounce either way. So it's just one indicator to use among many. I don't use it all that often. I will have a look on occasion, but I don't have a look at the RSI all too much because I know this is probably oversold right now, and I would expect a bounce, but the bounce might not happen. Okay, Michael Hill Jewelers, one of the best first names in the world. Michael. Hint, if you don't know my first name. Yes, so, well, I've got this downtrend line right there. It's like the downtrend line has been in play for a while. It's a pretty good looking downtrend line. It's been in play since the start of January. Share price of Michael Hill Jewelers back then was about $1.50. Now it's 67 cents. So a pretty weak looking chart. Why have I included Michael Hill Jewelers in this chart? So you can say just by looking at the weekly chart, this particular company moves in pretty well-defined trends. I forget the first maybe year. Share price moved from $1.75 all the way down to 25 cents in about 4 years. And then the next 2 years, it went from 25 cents to $1.50. And that high was reached in early 2022. So the last 2 years, Michael Hill Jewelers has been in a downtrend. In fact, I keep saying Michael Hill Jewelers, but according to TradingView, it's called Michael Hill International. Sorry, Michael Hill International. I am calling you by the wrong name. I have traded this company in the past. So during this period where the share price went on a massive tear, I actually traded Michael Hill International during that period, and then I sold out for a good profit. Right now, I probably am following this company a little bit more closely because of the valuation. So dividend yield 8% and price earnings ratio 20.33. But I think that is a little bit on the underside because if you look at the last half year, $15 million of net income after I lost the previous half year. So if you look at the annual numbers, last year was 35 million. Previous to that, this company had profit of almost 50 million 2 years in a row, between 40 and 50 million 2 years in a row. So if you say sort of a normal profit for this company would be between 40 and 50 million, this company has a market cap of 258 million, which means the PE ratio of this company is more like 7 or 8. That's on the assumption that a profit of 40 to 50 million dollars is normal for this company. That could be a pretty bad assumption. So I'm just following this company a little bit more closely because of valuation. But if I was just looking at this company just based off the chart, I'd be not interested in this company at all right now, just based on the chart. So, or valuation. If I saw the share price break above this downtrend, that would be a time to start getting interested. But yeah, share price still in a downtrend. Unlike Ansell, which I'm pretty sure I mentioned in a few videos during the week, they made an acquisition on Monday or Tuesday. Was it Tuesday? And the market liked it. They liked this acquisition. Share price broke out. And a bit of volatility in this company's share price the last few trading days. I could just imagine me taking a position if the share price fell to about $25.50 on the hope that it bounces from here because pretty good volume has come in. So the market liked this particular acquisition. Now, I'm always wary of acquisitions because research has shown the bigger a company is, the less chance any acquisitions are going to be beneficial for shareholders. So acquisitions are better for small cap companies than large cap companies. Ansell has a market cap of 3.2 billion. So maybe this is more in the realm of small cap companies, but I wouldn't call this a small cap company. Okay, dividend yield 2.5%. I wouldn't buy this company for the dividend yield. PE ratio of 21.8. But I think this again is in this instance where the PE ratio is not reflective of the true earnings of the company. And we can see that just by looking at the annual data. So a few years ago, this company had profit of 330 million. Now it's down to 220. And pre-COVID, the company had profit of 233 million. So a PE ratio maybe 15 to 20, yeah. And maybe a little bit of growth, maybe. Anyway, so just the chart here, that does look interesting. A nice little breakout on the back of an acquisition. Not my favorite type of trade on the back of an acquisition. I prefer on the back of a profit upgrade. That's my favorite trade, profit upgrades. I'm still waiting for a real profit upgrade. We haven't seen one for a few weeks, at least a few weeks, maybe even a few months. Okay, to my favorite ticker code, GQG. I had to think about it. And I think I mentioned this company on Monday. They released their funds under management on that day, and the share price rose 6.6%. The main thing about this was after that day, how does the market react? Share price went sideways. That's a good sign. Share price has been in a beautiful uptrend since about December. So maybe you've already missed the boat. Maybe. Dividend yield of 5.7%. Price earnings ratio 16.6. A pretty nice increase in funds under management. Possible trade here. Possible trade. Do I have this? I have this. I don't have it in my buy US or AUS or daily. I'm going to put this in my buy Australia. There we go. Just the chart looks pretty good. And I like the market reaction after that announcement on Monday. Okay. Now we've got two supermarket companies. Woolworths is first. So why Woolworths? Because I think I'm pretty sure I had Woolworths or featured Woolworths in one of my previous technical updates because the share price is at a really important level at about $32. Why is it important? Share price of this company got to $32 in October 2022. Remember, that was when the Nasdaq had its last really significant low. And all Woolworths had its low as well. So is Woolworths a tech company? I raise that question to you. Of course, we know the answer, but wouldn't be surprised to see in the next 5 years, Woolworths management comes out, the new CEO comes out and says, we are now a tech company, sort of like Domino's. We are now a tech company, Domino's said many, many years ago. Now they're a food company. And Woolworths, you will always be a supermarket. Okay, so share price fell a fair bit on when the company released their results in February. On that particular week, share price fell 8.9%. And share price has continued to show a little bit of weakness, but it did bounce off. The share price bounced off $32 at the end of March. The bounce was fairly weak. Share price moved into the short-term moving average channel and then fell back again. And looks like it might have tried to bounce off $32 again on the 11th of April. I think this is looking pretty weak. The reason I'm interested in this is I wouldn't buy Woolworths just yet. I still think this is way overvalued. Doesn't have a price to earnings ratio, but the market cap of this company is $39 billion. If we look at some of the annual numbers the last few years, so 1.6 billion profit, 1.5, 2, 1.2, 1.6. So say $1.6 billion of profit is sort of what you might expect for this company with maybe a 2% growth over time. So $1.6 billion of profit means this company has a PE ratio above 20. There's no way I would buy this company with PE ratio above 20. I don't care how defensive it is. You're not going to get much return with a company like this that's growing at a fairly low rate, a snail pace rate. Even dividend yield is fairly weak, 3.3%. Why would you buy this company for dividend yield? I just think people just get entranced or have been entranced by this company just because of the dividend, not the dividend yield, because of the defensive nature of the company. Anyway, so the chart looks really weak. Now, why am I interested? I think if the share price of this company breaks below $32, say goes to $31 or so, that would be a multi-year low. And I think this company is looking like it's moving into a downtrend. I would become interested in this company if the share price fell to say, I think halving from here would be unfair, but it could. It fell to a low of $16 back in 2016. I don't think it's going to do that now, because if the share price halved, the PE ratio of the company would be 12. And I think a fair PE ratio of this company is about 12, not 20, 21, 22, what it is now. So I still need to see the share price fall a lot from here for me to get interested. But maybe this is the first signs, the first move in a long downtrend for Woolworths Group. Now, on the flip side, we have Metcash. I'd be way more willing to buy Metcash. P ratio of this company is what you should expect for a supermarket chain. You might say, well, Woolworths is a much higher quality company than Metcash. Fair enough, and the margins are probably a little bit higher. In fact, no, we can't see. I think, no, we can see. Woolworths had margins. Let's have a look at the net margins, because they do show you net margins in TradingView. So Woolworths have a net margins of 2.5%, roughly. That's probably the average, 2 to 2.5%. While Metcash has net margins of around about 1.6%. That seems to be about average over the last 5 years. So there is a big of a difference in margins. So you do pay a little bit of premium for Woolworths, but Metcash has a PE ratio of 13.8, dividend yield 5.6. So just alone in the dividend yield, it looks nicer. But also the chart looks better as well. So the weekly chart, yeah, nothing much in the weekly chart. You could say long-term uptrend for about 5 or 6 years. But the daily chart does look interesting because the share price did break out. Share price broke out on the 12th of March. Share price has gone sideways since then and has moved towards the short-term moving average channel. And I think this could start going higher from here. So this start is looking a little bit bullish, Metcash. So don't discount Metcash just because it's a lower quality company than Woolworths. At this point in time, I think Metcash is the better investment for the long term just because of the valuation. Valuation matters. I was going to look at Asia ETF next, but I'm going to look at AGL and leave the ETF to last. AGL weekly chart looks like this. And when you look at the weekly chart, I'm getting rid of this right there. Actually, no, I don't. Look at that. So I had this resistance area here. And if all I do is just extend that across like that, and also almost lined up to the other line I put in. Okay, so if you just look at the weekly chart here, share price of this company was in an awful downtrend from the COVID-19 financial panic all the way through to late 2021, but it's in an uptrend, long-term uptrend. Why is it a long-term uptrend? Here's the low back in November 2021 at about $5, just above $5. And then we saw the next low in October 2022, then the next low, March 2023, and then the next low in February 2024. And all these lows match up. Not quite perfectly, but they match up. And since that low in February 2024, share price has been sort of riding that trend line up. And it looks like share price of AGL has bounced off that trend line. And if you look at the daily chart, you can see it bounced off it here. It's bounced off it again. 2 bounces off it. Now, it's not perfect when you look at the daily chart. But the other reason is that long-term resistance zone, it's been resistance and support. And you can see it. So this was in play way back many years ago. And then you can see it. The share price of AGL was in a downtrend here. This was in November 2023. It bounced off that level. Bounced off it. Wasn't very strong bounce, and that's why I think it failed a month later. And then look at this. On the 8th of February, share price opened up above the resistance area. Support turned to resistance and fell below it. That was fairly weak. It bounced off it again on the 19th of March. Look at it. Bounced off it on the 19th of March and fell lower, moved to the long-term trend, and now it's bounced off it again. And now AGL share price has just moved above that resistance area or zone, and possibly now it's support. This could be the breakout for AGL. I'm going to put AGL onto my buy Australia. I'm talking myself into making a trade with AGL. Now, the only negative thing is if the share price does get a little bit higher. Last time it was that high was back in January. So we're not talking about 6-month high. I do prefer 6-month highs, but I am a little bit loose with that rule sometimes. So AGL actually looks pretty good. Looks pretty good. Okay, Asia ETF. Talking about looking good. And this is, beta. Okay, so, this is the daily chart. And I had Asia sort of a resistance zone between these two dashed lines. And the reason that was a resistance zone is because over a 2-year period, 16-month period, where the price of Asia got into that resistance zone, we saw it pull back. Happened quite a few times, about 4 times. Moved into that zone back in early February. You can see it just transversing across that zone for about 2 to 3 weeks. From the 7th of February through to the 22nd of February, so 2 weeks, it just moved sideways. That's actually a good sign. That means there's no selling. And then it broke above it on the 23rd of February. Just look at it. Bit of strength in Asia ETF. So if you love your ETFs, Asia looks really good right now. This looks pretty good for an ETF. And Asia has been really weak the last few years, hasn't it? So look at this. This is the long-term chart, the weekly chart. Went as high as about $14.25 back in February 2021. So fair bit off that highs. And if you don't know anything about the Asia ETF, if I don't know anything about an ETF, what I do is I just put it into ComSec. There it is. And then I have a look at the holdings. It should tell you some of the holdings in the Asia. Here it is. So Taiwan Semiconductor Manufacturing Company, 13.5%. Okay, so one of the reasons I probably would not own this company is because I'm already a shareholder of Taiwan Semiconductor Manufacturing. Samsung is the second biggest holding, 10.4%. Tencent, Alibaba. There's a reason why this ETF has been weak. Tencent, Alibaba. Infosys, SK Hynix, NetEase, Honhai, Meditech. So there's quite a few companies I don't know anything about. I'd like to see a country distribution here. So we have, say, Taiwan, Samsung is Korean, Tencent is Chinese, Alibaba is Chinese. The other companies I don't know at all. All right. So if you like your ETFs, maybe Asia is one you should be looking at right now. Okay, that's all I got for today's video. Hope you've enjoyed it. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.